All right, so thank you all those that are out there and have joined our Preparing for Retirement webinar today. We really appreciate you making some time for us. We recognize that financial literacy is really important, particularly with all that's gone on in the last couple of years. And I don't know if any of you are watching your investments go up and down and more down than up, but anyway, it's certainly a time where we're looking ahead and seeing what is retirement going to look like. I was just listening to 680 News yesterday when I was driving. They're saying that the millennials are actually ahead of the baby boomers in terms of their retirement planning. And I think part of that is because people are seeing the writing on the wall that pension plans are becoming pretty rare. So I think this is a really timely webinar. Roland works for Eckler. Eckler is one of Oasis's partners, and they do consulting for us and financial services and communication, those types of things. And Roland certainly has some really good insights into the whole world of financial literacy. So we're really thrilled that he's with us today. I think you'll get some great insights. And I want to turn it over to Roland and thank him for presenting today.
Well, thanks, Karen, and very happy to be working with you to deliver this. As you mentioned, it's a very timely webinar. So Oasis is presenting today's webinar on preparing for retirement. So Karen did introduce me. My name is Roland Chiwatelu. I am a financial wellness consultant with Eckler, and Oasis selected Eckler to collaborate on providing this support to Oasis members. And so we are independent. Eckler is independent from Oasis. We work with other organizations and employers similarly across the country to deliver, these types of financial wellness programs to their employees and their members as well. A couple of housekeeping things. So we are recording this webinar, and the recording should be posted up on the resources section on the Oasis website. So you can look out for it. I would say wait for like a week. Around this time next week, you should be able to find this up there, as well as the previous other webinars that we have done in the past as well. The time that we have for today's webinar, we have an hour, so we have until the bottom of the hour. And the way we want to break it up is we want to go through the presentation content first. There's quite a lot of content that we want to get through in the time that we have. And then hopefully we'll have enough time at the end, aiming to have about 10 minutes of Q&A time at the end. But by all means, if you're at all familiar with using Zoom, and maybe you've attended other webinars or meetings over the last couple years at least, you will know that there is a Q&A button or a chat button. So you can feel free to put your questions in the Q&A and sort of start a queue. And then once we get to the end during the Q&A time, I'll just open up the questions that are already in the queue and start addressing them one at a time. For those who are more inclined to send their questions via email after the webinar, so you've had some time to digest the information, and then you have questions, you will also be able to reach out via email. There's an email inbox address that we will show you at the very end of the presentation. So those who want to send follow-up questions. So this is the agenda, what we want to cover today on this, really big topic of talking about preparing for retirement. We're going to start off talking about, the financial aspects of it. How much do you think you're going to need? How do you rectify that based on your own personal and individual circumstances? And then quickly we'll go through the major sources of retirement income that some of you will likely be relying on. We'll look at the government benefits, a quick highlight of that, workplace pensions, a quick highlight of that, and then a little bit on personal retirement savings. How do you take your RSP, your tax-free savings account, for example, and then convert that into retirement income for yourself? So that's the financial aspect of it, but we also want to cover health as an important part of retirement planning. So healthcare in retirement, what does that look like? What does that cost? Who are the different payers? And as you prepare for your retirement, how do you factor in healthcare costs and expenses? And then finally, we'll talk about life after work. So it's not just thinking about what you're retiring from, but you also need to think about what you're going to be retiring to, what your lifestyle is going to be like, who you're going to be spending your time with, where do you see yourself residing, and how do you shape that lifestyle aspects of your retirement. So that's the agenda in how we hope to cover today's session. Hopefully you find this all very valuable as you continue to prepare for your retirement. And so these are the major considerations, I think, right? The thing about this is that you can clearly see that there's an interrelationship, there's a connectedness going on here, because if there's something unexpected, for example, that happens health-wise, then it's very likely going to impact your lifestyle and very well also could impact your finances in terms of expenditures, out-of-pocket expenses. So you can see that there's this interrelationship, and that's why I think these are the major considerations. Many pre-retirees, if you ask them, what are they mostly concerned or thinking about with regards to their retirement planning? Number one, A and B on the list is usually going to be some combination of money and health. And so we want to talk about that and how it impacts your retirement plans and retirement lifestyle, and what you might want to do to be able to give yourself the best chance to mitigate any of these types of unexpected things popping up. So first, we're going to talk about the finances. And you may have heard of some traditional rules of thumb with regards to how much retirement income you need. So for example, this one particular rule of thumb is that 70% of your pre-retirement income is what you need to be able to maintain your lifestyle in retirement. So what does that mean? Well, if you take a look at your salary in your last year of working, then 70% of that, so whatever number that equals to, is how much you need every year to provide yourself enough retirement income so that you can maintain your lifestyle. And that rule of thumb, and basically any rule of thumb, may not prove to be the case for your unique situation. And so rules of thumb are really not adequate for hardcore retirement planning, getting into the details, into the weeds, because you have to really understand the context of your own circumstances. I want to say circumstances and situation at the same time. You want to understand the context of your own situation and really get into the nitty-gritty of doing retirement planning based on that, based on your personal situation first. Because the goal that many of us have is to maintain our lifestyle, right? So that's what most of us want. We don't want to see a downgrade in our lifestyle once we transition into that next phase of our life. We want to at least be able to maintain it. That's the goal and that's the point, right? And that's why we're doing all this planning ahead of time. But your lifestyle is going to be very unique to you, different to you compared to somebody else's, which is why blanket rules of thumb don't make sense to follow. So take, for instance, let's say you're a family living in an expensive urban city. You may not have a lot of disposable income because much of that is going towards, things like housing, childcare, activities for the kids, saving for their education, saving for your retirement. And so maybe there's not a lot of disposable income for you to take vacations. Maybe you're able to go take a vacation, once every few years or even longer than that. The thing about that kind of I'm generalizing, of course, general situation is that you might anticipate that some of those expenses reduce by the time you're ready to retire. So maybe you've paid off the house. Maybe the children that you're raising have now become independent and no longer need you for support. And so you might be able to then retire, maintain your same standard of living by only replacing maybe 50% of your pre-retirement income. So, that's just one example. And especially if maybe you're able to downsize the big family home and move to a cheaper area. Compare that to a different circumstance. Someone else, maybe that might be single, doesn't have a lot of dependents. Maybe they're living in a more low-cost area, suburb or exurb or smaller city, mid-sized smaller city. And then you might anticipate that they have a lot more disposable income, right? Because of their circumstances. Maybe now they're taking a trip every 6 months because they can afford to. They don't have as many dependents to look after. And so they have a higher standard of living. You might then anticipate that this person, to be able to retire and maintain that same high standard of living, might need to replace more than 70% of their pre-retirement income. So you can see how rules of thumb really quickly break down, because this is really about looking at your personal circumstances, your personal situation, and then going off of that and doing your planning based on that. But I think there is one general rule of thumb that I still think is a good idea that many of us try to follow with our retirement planning, and that is to aim to be debt-free by the time you retire, right? Because if you don't have debt payments to pay, interest payments that you're still paying, it just gives you more freedom and flexibility to then be able to maintain your current living standards, because you're not spending X amount of dollars every month paying interest, trying to pay off that debt. But the reality is, that more people are carrying debt into retirement than before. And I think in particular, if we're looking at what is going on right now with higher inflation than we have seen in recent decades, what is beginning to happen is that the central bank of the country, the Bank of Canada, in its attempt to start to rein down that higher inflation, because we've all seen higher inflation, right? When you are going to the grocery store, you can see that your groceries are a lot more expensive today than they have been in recent years. To try and combat that inflation, the central bank, the Bank of Canada, is raising interest rates. And when they raise interest rates, that then feeds into the rest of the economy, because the commercial banks, so the banks that you have your bank accounts with and that you have your loans with, they then raise interest rates. And so if you're borrowing money, or if you have debt already, your cost of borrowing is going up. The interest you're paying on your loans, your lines of credit, those are now going up. So we're unfortunately going to feel the impact of that. And if you are looking at retiring and you're carrying debt during this period where interest rates are going to be a little bit higher than we've been accustomed to in recent years, that just means you're going to have less and less money available to fund your lifestyle, and more of it is going to be going towards paying down debt. So you still want to try and aim to be debt-free by the time that you are ready to retire. So beyond paying off your debt, you may start to anticipate what your other expenses and how they might be changing as you are getting ready to retire, because some expenses might be going down. In the previous example that I used, looking at the family that might see some of their housing expenses go down if they paid off their mortgage, some of their childcare expenses go away once the kids have grown up and they're now a little bit more independent and they're not depending on you. So if you're waiting to retire, once you've paid off your mortgage and the kids have gone, you might anticipate being able to maintain the same standard of living and having some of those expenses come down. Income taxes is another one. So typically your retirement income is going to be less than what you were getting in your last year of work. And so income taxes should be less. Also, some of these work employment deductions that you may no longer have once you've retired, like your Canada Pension Plan contributions, your EI contributions that you see coming off each paycheck. Once you've retired and you're no longer in an active worker getting employment income, those deductions aren't going to be there anymore. And then your retirement savings. So the money you're saving for retirement, once you've retired, that's like an expense that you no longer have to worry about. And then commuting, work, clothes, food costs, some of these expenses associated with work. Granted, some of us have seen these reduce if you were working from home primarily over the last couple of years because of the pandemic. But if you're starting to go back into the office, or if you never stopped going into the office, as many working folks, that was the reality for them, then maybe you still had some of these expenses. So once you've retired, it's like those permanently are reduced. But on the other side of the ledger, what expenses might you anticipate actually going up realistically if you look at it? Maybe if you're planning on doing more travel, if you're going to take the more leisure time that you have, dedicate it to more of your hobbies. and those types of activities, you might see those expenses go up a little bit. And then, as we mentioned, health insurance, healthcare costs, which we're going to get into towards the latter part of the presentation today. So what we all want to be doing, I think, ideally, is that you should know what your lifestyle costs you today. So if you're tracking your spending, say you're aware of how much you're spending every month right now on housing, food, shelter, all of your household living expenses, both essential and non-essential, then what you can start to do is you can take a look at each of those categories and project, right? Estimate is really what you're doing, that when you retire, which one of these in each category do you anticipate those expenses dropping or increasing or staying relatively the same? And so that can help you take a look at, okay, if you understand today our lifestyle costs us $5,000 a month, once you've done these projections in each category, total and add it all up, you can see, okay, we think we might need $4,000 or $3,000 or $2,500 every month in retirement to be able to maintain the same lifestyle. Another important variable is to think about your expected longevity, because the longer you live, really the more you need in terms of your financial resources to fund your retirement, because the longer you live, you need your money to last longer, you need your savings to last longer to continue to provide the resources you need to live in retirement. And we're living longer and longer and longer. So basically, if you get to age 65, your odds of then living until age 80 as a male is greater than 70%. As a female, is greater than 80%. To make it to age 85, so that's living 20 years past, 20 years longer once you've already hit 65. As a male is greater than 60%, as a female is greater than 70%. And then what about age 90? So that's a retirement that is at least 25 years long. If you make it to age 65, then odds are greater than 40% as a male, you make it to age 90, 50% as a female that you'll make it to age 90. And then finally age 95. So a 30-year retirement if you retire at age 65, 20% chance for men and 30% chance for women. So you need to also think about your longevity when you are doing your retirement planning. We're going to look at an example coming up of using a retirement calculator to help you pool all of your different retirement income sources and start to project the retirement income that you can get from them. You're going to see how thinking about your longevity plays a role. And so you want to be conservative when you use these retirement calculators by anticipating that you're going to live longer than you think, because we tend to think that our life expectancy isn't quite as long as what the actual data shows. And here's what the actual data shows, that you're going to be alive or around in your retirement potentially for decades, which is longer than any generation before has experienced during their retirement years. And so longevity is an important factor with your retirement planning. What are the major sources of retirement income? The three main sources of retirement income are government, workplace pensions, and your personal savings. So I think what we want to do is you want to try and understand, as you're preparing for your own retirement, you want to understand, all right, what each of these major sources, what role they're going to play with your retirement plan. So how much are you expecting from government, Canada Pension Plan, Old Age Security, Guaranteed Income Supplement, if that's the case? Do you have a workplace pension? And how much income can you anticipate getting from that? And then lastly, personal savings. What's in your RSP, tax-free savings account? Do you have other savings? And then we can use and put those into your retirement calculators to try and figure out how much income you might get from there. And so how do these all come together? Trying to understand a few things. Number one, longevity, as we looked at. Some of these retirement income sources are going to be paying you a guaranteed annual or monthly income for as long as you live. So there's no way you can outlive these sources of income. Particularly, we're going to be looking at Canada Pension Plan, Old Age Security, because the government benefits, that's how they work. They give you a guaranteed annual income for as long as you live. Then workplace, depending on the type of pension plan, you might get a similar arrangement where you get guaranteed income for life, or you have a pot of money that you have to manage and provide income out of that during retirement. And it is not guaranteed to last forever. And then lastly, your personal savings, same thing there. So we're going to look at what all these different options are and how you look at that in terms of the longevity security that you might get from them. Starting with the government. So this year, the maximum amount of Canada Pension Plan and old age security combined for somebody who's already receiving them is around $22,000. Okay, $22,000 this year in 2022 is the maximum combined CPP and OAS. So you can think about that. How much is that? Well, you know, if in your last year of working, let's say you earned 60K. In your last year, you retired and then started collecting your CPP and OAS, and you were getting 22,000 from CPP and OAS. So that's about a third of your working salary that you've replaced only with the government benefits. And so that's not an insignificant chunk of money. I think what you all want to be able to do is to figure out how big a role CPP and OAS is going to play for your circumstances. What is the replacement ratio for you when we're just looking at the government piece of it? Now, there have been recent changes to Canada Pension Plan where that same replacement rate, so the example we just used where we said someone was making 60,000, they retired and now they're getting 22,000 from CPP and OAS. Well, recent changes are going to actually increase the replacement rate for most working Canadians who are just starting in their careers today, because the changes specifically are requiring all of us who are working to contribute a greater percentage of our income into CPP. That started in the early part of this. Actually, no, that started in late 2017, 2018 is when the enhancement contribution started. And then they were phased in over a period of time. Higher and higher percentage of our income do we have to contribute to CPP. Now, if you're getting close to retirement, you've been contributing for most of your career under the old rules. So this is not going to, in a significant way, change how much CPP you're going to get. That's why I mentioned those who are starting their careers today, they're going to see a higher replacement rate. More of their retirement income is going to be coming from CPP and old age security based on the changes to the CPP program in recent years. We just did a deep dive into Canada Pension Plan in a webinar in November. So those of you who are interested in looking at that webinar, you should be able to find it on the OASIS website. Now, Canada Pension Plan is based on your contributions, how much you have been contributing over your working time. So if you didn't work, or if your income wasn't high enough to allow you to contribute the maximum each year, then you're not going to get the maximum CPP benefit when you retire. Okay, most people don't get the maximum CPP benefit when they retire. Old age security is a little bit different. It's based on your years of residency in Canada. So how many years, how long have you lived in Canada? And they're really looking between age 18 and age 65. So between those two markers, how many years did you spend living in Canada? To get the maximum old age security benefit, you have to have lived in Canada for 40 years, 40 years between age 18 and age 65. So if you didn't live 40 years in total between those two age milestones, then you're not going to get the maximum out of OAS either. So I think what we all need to do to help you with your retirement planning is to request your Canada Pension Plan statement of contributions, because from there, they will show you an estimate of what your CPP retirement benefit is going to be based on your contribution record during your career. Now, I should talk about the Guaranteed Income Supplement, which is at the bottom of this slide. The GIS, or the Guaranteed Income Supplement, is a benefit for low-income seniors when they start to receive their old age security pension. So if their income is low enough, they'll also collect this Guaranteed Income Supplement as well as the old age security pension But the GIS portion, the GIS payment is tax-free, whereas CPP is taxable income and old age security is also taxable income. So we'll do a quick highlight on workplace pensions. Most working Canadians, as Karen said in her introduction, most working Canadians are not part of a workplace pension plan. In fact, from the last Stats Canada data on this, less than 40% of all working Canadians take part in a workplace pension plan. Then, if we take away those working people who work in the public sector, and so what's the public sector? The public sector is defined as those services or jobs that are owned or controlled by the government. So think of services like the military, for example, law enforcement, like police and fire, public education, healthcare, so nurses, doctors, and of course, our elected and non-elected government officials and workers, they all kind of make up the public sector. And so if you remove those folks, and we only focus on the remaining workers, which we'll call the private sector. So if we're only looking at the private sector, now we're down to about 20% of Canadian workers in the private sector who have a workplace pension plan. So most working people in this country do not have any type of workplace pension plan. So if you do have one, then you want to understand what role it's going to play in terms of providing you with retirement income once you retire. It's most likely that you have either a defined benefit pension or a defined contribution pension. And there are differences between the two. First, the defined benefit or the DB plan is based on a formula. So it's based on years of service, some definition of earnings or salary, and then it's multiplied by a certain factor. And that basically equals your pension once you retire. With a DB plan, the pension that you get, the income that you get for retirement is typically payable for life, right? So it's like you're gonna continue to get a paycheck every month. Money is deposited for as long as you live. And then once you die, payments stop unless you have a surviving spouse, and then there may be survivor benefits for that. That's the DB pension. The DC pension or defined contribution is different. This one is based on an account. It's like an investment account or savings account in your name. You and the company might be making contributions to it. Sometimes it's only the company. So there's money going into this account, but you have to decide how it's invested. And hopefully you are investing it in a way so that the money in the account grows. And then once you retire, whatever amount is in that account, you're going to use to provide yourself with retirement income. So those are the two different types of workplace pensions. When it comes to your own personal savings, so let's take a look at the RSP, for example. If you have an RSP, Registered Retirement Savings Plan, you make contributions into that account, and then eventually you're going to take money out of that account to fund your retirement. And so what does that look like? Well, you can convert your RSP into a retirement income stream at any time, but there's a deadline. You have to close out your RSP and start to draw income from it by the end of the year that you turn 71. So that's the last year that you can have an RSP, after which you are now forced to convert it into retirement income and start to take money out. So what are your options of converting your RSP to retirement income? Well, first you have the RIF. The RIF, or the Registered Retirement Income Fund, will cover what that looks like. Then you can also purchase, with the money in your RSP, you can purchase an annuity. So we'll look at what annuities are. And then of course, you can always just cash out all the money in your RSP, pay the tax, and then do whatever you want with the money that you have cashed out. So let's take a look at the RIF. If you convert your RSP into a RIF, then it's kind of like you have changed the name of the account. Now it's no longer known as an RSP, now it's known as a RIF. You do this with your financial institution, whichever financial institution that you have the account with, then you can convert your RIF with them, or you can take it to a different financial institution and convert the RSP to a RIF there. But once you've converted your RSP into a RIF, you're going to have to choose new beneficiary designations. So you're going to have to redo your beneficiaries. And also you can change the investments if you like, or you can keep them the same. So you can continue to have the same type of investment mix in the account. But what has happened now, the major focus of turning your RSP into a RIF, which reminding you that you have to do by the end of the year that you turn 71. You can do it anytime before that, but that is your deadline that you must do it by, is that now you have to actually start to take money out of the account. You're forced to take money out. In fact, there are annual minimums that you must withdraw from the account. So you'll be working with your financial institution to do all of this, right? Convert the RSP into the RIF, and then figure out what the minimum amount you must take out every year. And so anytime that you take money out, it's taxable income. So there's a minimum you must take out, but there is no maximum that you are capped to, meaning that you can withdraw all the money in the account, in the RIF account, at any time if you want to. So remember, one of your options with converting your RSP into income is to purchase an annuity. So what does an annuity look like? What type of a product is this, and how does it provide you with a retirement income? So there are different types of annuities. You can buy a term annuity, so an annuity that pays you income only for a specified term or period of time, so 5 years, 10 years, 20 years. Or you can buy a life annuity. A life annuity is a contract with the annuity provider where you are giving them the money in your account. So in this case, let's say you're giving them the money in your RSP. And then what do you receive from the annuity provider in return? You get life income. You get income guaranteed for life. So in our example on this slide, let's say you've purchased an annuity that is going to be paying you $600 a month. Well, that means you're going to get $600 a month for the rest of your life. If you die soon, that's the downside, right? So it's a way of risk, mortality, what's the word for it? Mortality sharing or mortality risk pooling, meaning that those who buy annuities that then pass away soon after, they end up subsidizing for the people who live a long time, because you only get the amount of monthly income that you have negotiated with the annuity provider, right? It's like a contract that you sign. By the way, you can shop around for this at different annuity providers. The annuity providers, by the way, are the life insurance companies. So this is kind of like a life insurance product, right? So you can go to Sun Life, Manulife, Great West Life, or Canada Life, I should say, or any other life insurance company, and say, okay, I've got 100,000 in RSPs, 200,000 in RSPs, 50,000 in RSPs, and I'm interested in using all that money or only a certain portion to buy an annuity. How much can you provide me in guaranteed income for life? And they will show you. And you can shop around, as I mentioned, because different annuity providers will offer you different amounts. And so that's basically how annuities work. You're getting income security for life. You cannot outlive the money that you get from an annuity. It's similar to Canada Pension Plan and old age security that way, in that you only get income for as long as you live. The risk, though, with an annuity is that you might die a lot earlier than anticipated, and now all the money you've paid, you haven't gotten that back in income. Whereas on the other end of that spectrum, if you have really good longevity, chances are you're going to get a lot more than the money you paid into it, paid back over time in terms of the annual income stream. So that's kind of the two difference. A RIF account, you control the account and you determine how much money you take out, as long as you take the minimum out, but you can run out of money. It's possible. Whereas with an annuity, it's not possible. You get income for life if you buy a life annuity. So for many people, they're going to prefer the flexibility that a RIF provides them, certainly at least in the early stages of their retirement. And then once you get later and later to your later stages of a retirement, you know, your 80s, mid 80s, and so on, you might then want to look at an annuity to give you at least a guaranteed amount of income for the remaining years of life that you have left. All right, so taking those different income sources, how do you then put them all together to project your retirement or estimate your retirement income? So this is where it's a good idea to use a retirement income calculator to help you estimate your retirement income from all sources: government, workplace, pension, and personal savings. I think you definitely want to be doing this using retirement income calculators at least once a year when you are 10 years or less remaining until your retirement, your target retirement date. Because this will help you know if you are on track or not, and it will help you decide what changes to make if you do find and see that you're not on track. So this particular retirement calculator we're using is the Canadian Retirement Income Calculator that is on the Government of Canada website. So you can do a Google search by just typing Canadian Retirement Income Calculator, or if you go onto the canada.ca website, you can find it from there. But this one I find is very, relatively easy to use. So, you'll want to put in your birth month and birth year. And then, of course, you need to put in your current annual income before tax. And then you need to put in what you expect or estimate your retirement income needs are going to be. So in this example, this individual, she thinks that she's going to need $30,000 a year in retirement to maintain her current lifestyle. Next is your life expectancy. It defaults to age 88, but if you want to be more conservative and assume you're going to live longer, then click no and enter your own retirement longevity age. I like to use age 95 as a default, just to be conservative. So right away, once you enter all that information, you're going to see in the graph right beside it, it's already going to have your estimated annual retirement income there as the line, as the mark that you need to hit. So in this example, $30,000 a year. So then you can progress in the following tabs that you can see at the top of the screen. So the next screen will take you through Canada Pension. I think it's a good idea to request and have your estimate of your CPP from Service Canada first. Then you can take a look at your statement and your estimate and plug in the numbers into the tool. Next, if you already have your most recent workplace pension, then you can also plug in the information into the tool. And finally, your retirement savings, so your statements from your RSP, your tax-free savings account, all those personal savings that are going to be playing a role in your retirement, get those statements, have them ready in front of you, and then you can plug in the data into the tool so that you can, at the end, get some information to see whether you are on track or not. So this example, the retirement goal was $30,000 a year. And based on all the information that they put in, their annual average retirement income is estimated to be about $27,000. So a difference or a gap of about $2,000 each year. So it shows you that, but then it also breaks it down into each specific income source so that you can see the role it's going to play in terms of your total income picture. Canada Pension Plan, old age security, workplace pension or not, personal savings or not. So now you can start to make some decisions. In this example, this person now has to decide what they're going to do if they want to close this gap of about $2,000 a year. Does that mean that they're going to be looking at maybe working part-time for a few years during their retirement? Or maybe saving a little bit more in their retirement savings today. The other option, if you're not going to try and increase your earnings or savings, is to try and reduce your spending so that you can anticipate living on a little bit less to maintain the same lifestyle as well. So those are some examples on how you might take the data that you're getting from the tool to help you make some changes that are going to help you more likely meet your goals. All right, so let's look at healthcare and retirement. So I'm going to launch a poll. It's anonymous to answer these polls, by the way. It's just for fun. And the question here is, what percentage of Canadian seniors do you think are reporting having one or more chronic health conditions? Do you think that it's 20 to 35% of seniors, 50 to 60%, or 75 to 80% of seniors? Give you a few minutes, or sorry, seconds to put in your answer. All right, so let's end the poll and share the results. So with 50% of you picking 75 to 80%, that is indeed the correct answer. So 75 to 80% of Canadian seniors report having one or more chronic health condition. So Canada's population is aging. For the first time, we now have more people that are age 65 and older than there are children between age 0 to 14. Seniors are expected to make up 25% of the population by 2036. And the fastest growing age group are seniors age 85 and up. So as we age, the odds of illness increase, particularly chronic conditions and diseases like cancer and dementia. So I think we want to try and understand who the major payers of healthcare services are in Canada. And as you can see, mostly it's the government, to the tune of approximately 70% of all healthcare costs. So if you're young and you're working, you may also have a workplace insurance benefits or a union plan that is covering about another 15% of healthcare costs. But with the movement away from employer-sponsored retiree benefits, this means that many Canadians long accustomed to paying little attention to the cost of their healthcare consumption, they're now ill prepared for the possibility of more healthcare costs needing to be covered by their retirement incomes when their employer or union benefits end. So let's attach some numbers to this. Based on the Canadian Institute of Health Information, the CIHI, this graph was using their data from their 2019 healthcare expenditures report. This graph shows the public and private sector spending by age. So what you can clearly see is that there's a sudden and rapid spike or growth in healthcare costs after age 65. I have a colleague who specializes in workplace benefits. So she gave a talk and she put this graph together. Using this data set, she projected that a 60-year-old today, if you just focus on the private sector spending, not the public sector, so not the government healthcare costs, but the private sector costs, so those expenses that are coming out of their pocket or from private insurance, then a 60-year-old today is projected to need or to use $3,000 to $15,000 per year of private sector healthcare spending as they age. And that number getting bigger once they hit, age 85 and beyond. So what does that mean in terms of, how much do you need to have saved already to be able to pay for this future expense? That means a 60-year-old today should have $145,000 available now to fund their future healthcare costs. So that is just to pay for their future healthcare costs, not including what they need to fund their other aspects of their lifestyle. So this is a significant expense that many, I think, Canadians are unprepared to face as they age in retirement. So what can you do? Well, the first thing is to find out if your employer provides retiree benefits and if you are eligible to participate in that type of plan. Because if they do provide retiree benefits, you would want to know what is covered under that plan. Is there dental coverage? Is there out of country emergency travel coverage? Are my dependents covered, or is it just me? And you want to know how long that coverage is for. Sometimes retiree benefits will cover you for life, and sometimes they'll only cover you up to a certain age. Now, what if you don't have access to employer-sponsored retiree benefits? Like most people, that will be the reality. Is then you might want to consider converting your current workplace benefits or union plan insurance into private insurance when you retire. So you do this at the time that you are retiring and leaving your employment. It's not something that you are going to be doing now. It's only at the time that you retire and stop your active employment. You will have this period of time that you can convert your group plan into a personal plan. And the advantage of doing this conversion is that you do not have to show any evidence of insurability or answer any health questions. So if the way to think about this is you're basically taking the existing workplace insurance plan that you have now and continuing it on, even though you have left your employment. And so you're just going to continue the same coverage, the same plan. And the advantage is that you don't have to show that you're healthy or answer any health questions or pass any sort of medical examination. Because if you were to, for example, cut off all of your workplace pension benefits and then go and try and replicate that on your own with private insurance, you're going to have to prove that you're healthy. And maybe you'll be excluded on some sort of medical coverages that you might not be able to get. So that's the advantage of doing the group conversion, is that you don't have to show any evidence of insurability. There might, though, be coverage limits. So you want to be aware of that. And then the conversion period, the time that you have to do this conversion is typically about 31 days from the day that you've retired. You'll have about 31 days to trigger this conversion. Now, the premiums that you're going to be paying, there you will see a change there compared to the premiums that you're paying now as you're actively employed and part of the workplace benefits plan. The premiums will go up. So that's something to also keep in mind. Now, as we've seen, the bulk of your costs will still be covered by government programs. So what is typically covered and what is not? The big thing, though, underlying all of this is that there are differences among the various provincial governments because healthcare is administered provincially in Canada. The federal government gives money to the provinces. The provinces have to use that money to administer the healthcare plans and programs. So there are differences across the country, but typically your acute healthcare needs are going to be well taken care of. So if you need to see a doctor or if you need to visit the hospital, across the country, that's usually going to be covered, and that's no different for seniors as well. Depending on your province of residence, you might have some prescription drugs covered. So for example, Ontario has the ODB, Ontario Drug Benefit Program, that covers thousands of prescriptions. So that's something that you might want to take a look at in your province of residence to see if there's some sort of plan that covers prescriptions and how extensive is it? What are the prescriptions that it covers? Because it could be that some coverage, that some prescription that you need might not be covered, and then that's going to be coming out of your pocket. Home care and long-term care might require you to apply and get on waiting lists for the public home care and long-term care services that are available. Or you might opt for private money that might be more accessible and available, but is typically going to cost you a lot more than what is publicly subsidized home care and long-term care that is available. And then if you live in a more rural area, it can be even harder to access those types of services. So you do want to take a look in your province of residence to see what the home care and long-term care services look like. As for what is typically not covered, vision care is one. So eye exams you tend to be covered, but then the frames and lenses, you might have to pay out of pocket there. Dental care. So I think famously there's news being made on that front in that the federal Liberal and NDP government are making a coalition. And one of these policies that they want to address is have a national dental care program. So we want to see what that proposal looks like and how it becomes law over time. And then we'll have a little bit more of an idea of what it's going to mean for seniors in retirement. But of course, like massage and physio, all these types of supportive services are typically not covered anymore in government healthcare for seniors. And out of country travel, again, limitation in coverage depending on the province that you live in. Prescriptions typically are not covered. And so I think it's still recommended that if you know you're going to be spending time out of the country, if you want to be a snowbird, you might want to consider having some private travel insurance as well. Now, so with the rise of home equity values across the country, this presents an opportunity for some of you who are homeowners to be able to tap into your home equity to fund some of this future healthcare needs and costs that you might face in your retirement. So that means, retirees looking to age in place, you can tap into the equity in your principal residence, for example, to help provide and support your retirement income and your healthcare needs. So one of these tools or one of these programs is a reverse mortgage. And reverse mortgages can be taken out by homeowners that are age 55 and over to a maximum amount that can be borrowed is up to 55% of the value of your home. Now, these lenders like to be the first debt facility on title, meaning that any outstanding mortgages or any lines of credit will have to be paid off first and closed using the proceeds of the reverse mortgage. However, to qualify, there's usually no income requirement because there aren't any regular payments to be made. You simply pay the loan back when the home is sold or when the homeowner moves away or dies. So if you want to compare to a traditional mortgage, the reverse mortgage typically has higher borrowing costs. Another option is borrowing from the equity in the home using a home equity line of credit. Compared to a reverse mortgage, you can probably get a little bit more equity out of the house, but you do have to pass an income test. So the bank is going to want to see what your income is and your ability to be able to make the monthly payments, because there are going to be monthly payments. Typically, the monthly payments are just interest only. And now you're going to have more comparable borrowing costs to a traditional mortgage. Another consideration is with regards to government retirement benefits, Canada Pension Plan and Old Age Security, because both programs are centered on age 65 being the normal retirement age. However, with Canada Pension Plan, you can start it earlier. You can start it as early as age 60 and receive less. You'll get a reduction on your monthly payment if you take it early, or if you defer and start it later, you'll get an enhancement. You'll essentially get more on your monthly payment. Old age security is eligible at age 65, but you can also defer it up to age 70 and receive a bump on your monthly payment for deferring it. So this is something to think about. Each individual has to decide when they want to start their government benefits. The major factor obviously is longevity, right? Because if you have, if you're expecting lower life expectancy, then you're better off starting your CPP and your old age security as soon as you can, okay? But if you're looking at more normal life expectancy or longer than that, then you might have a decision to make. The other factor is, what are your obligations? So if you're going to retire how much do you really need this income because of your other obligations? If you need this income, then it's better for you to start it as early as you can when you retire. So those are the factors in play. But I think more people can look at deferring this and starting these benefits later. And it's going to really play a big boost in terms of additional income that you're going to rely on down the road as you age and your healthcare costs start to creep up higher and higher. All right, so last couple of slides, we want to look at the lifestyle part of retirement planning. Planning for life after work is really helped by having a vision for your retirement, which is easy to say, but it's difficult to do because you're trying to think about all these major areas of your life, such as we talked about, your health. You're trying to project what your health looks like in terms of how many more active years do you have left to be able to do some of these things that you might have on your bucket list. And then what activities are you going to be doing that are going to give you sort of the everyday fulfillment and joy in your life? And that's the challenge, right, of coming up with your vision. So to do that, I think what can help is if you think about these 8 areas, right? Number 1, home and location. Where are you going to live? And then social. Who are you going to spend your time with? Are you going to be spending your time, you anticipate, with more family? Do you want to be closer to your family? Or maybe do you want to be further away from your family? What happens as you age, because this is what happens with all of us, the older you get, the more funerals you're attending. So what happens as you are outliving your loved ones, families, members, friends? How does that impact your social circle and your need for social interaction? What hobbies and interests, what things are you going to be doing that are going to give you fulfillment every day and meaning into your life? And then, of course, health, not just physical, but mental health, intellectual stimulation as well. Spirituality is not really about religion, but it's about your overall well-being. So you want to feel fulfilled, right? We all want to have a meaningful, happy life. This is true for all of us, no matter what stage of life we're in. And then finally, your financial well-being, having the resources to be able to make this retirement vision come true. So something that can help you with your lifestyle planning for retirement is this concept of disengagement and replacement. Because if you think about it, today that you are working, you probably do get some of your personal needs met. So for example, income. Well, once you've stopped working, you're still going to need income. Where are those income sources going to be coming from? We talked about earlier, government, workplace pension, perhaps personal savings. So think about how you are going to replace your need for income. What about time? Right now, as you are working, you spend a lot of time at work. And once you've disengaged, that becomes leisure time. So now how are you going to spend that time? Relationships. What is your circumstances around your relationships today? And then once you've disengaged from work, because maybe for some of you, a lot of your relationships are coming from work. Contribution, right? If you're someone who feels really connected with the work that you do, that you're making a contribution, also that it gives you a certain status and role, these are high personal needs for you. Once you've disengaged from work, how are you going to replace these personal needs? Where are you going to feel like you can still make a contribution once you have retired? So hopefully this all helps you. So the key takeaways, we want you to help you think about the need of retirement, your retirement expense need. Once you have transitioned into this next phase of your life, your goal is to maintain your standard of living. It's going to require income. So you want to think about how much you're going to need. And then take a look at all your retirement income sources. So we talked about gathering your Canada Pension Plan statement of contributions, getting any workplace pension statements, personal savings as well, so that you can use a retirement calculator to help you plan. Find out if your employer offers retiree benefits, and have a plan in general for increasing healthcare expenses as you age. And then age gracefully, enjoy your life after work. This is an exciting next phase of life. And if you plan properly, then you can mitigate some of these unexpected things and the unexpected outcomes from them. Because there are going to be unexpected things, that's life. It's having a plan in place can help you meet and manage those. So hopefully you found this valuable. We've come to the end of our webinar. I do want to take a look at the Q&A, and I see that there's one question. So the question is, you mentioned that to be eligible for the max OAS, you need to have lived in Canada for 40 years between ages 18 and 65. Do you also mean that you must have also worked for these 40 years? No, there's no requirement to have worked. It is simply a requirement of residency, living in Canada. So that's why, even though Canada Pension Plan has a maximum payment is bigger than the maximum payment that is coming from old age security, the government is spending more money paying old age security benefits than the total Canada Pension Plan benefits that are being paid, because more people are just going to be qualified and eligible for OAS, because there's no requirement to have worked to get OAS. It is simply a residency requirement. Whereas with Canada Pension Plan, you must have worked to make a contribution to CPP, then thus you can apply and receive some payments in retirement. So thank you for that very good question. Are there any more questions? I don't see any more questions. So as you leave, please take a moment to fill out the feedback survey. It's about 6 or 7 questions that will pop up in the window once you've closed the webinar. Looks like we got one more question. So those of you who have time, I'm going to look at this last question. So as a follow-up question to that, you have to be a resident of Canada. What if you immigrated here and only became a resident less than 10 years ago, but have been living here for 20 years? Right, so yes, you do have to be a resident of Canada. So it is possible that you immigrate to Canada and then not have enough years of residency to qualify for OAS. The minimum years required is 10 years. 10 years is the minimum to get any OAS, and it's a prorated calculation, meaning 10 divided by 40, 40 would be the maximum years. And so then you would get 25% of the maximum OAS payment. So yes, it's based on years of residency. And if you don't have enough of the years of residency, that's going to impact how much OAS you're going to get, if any OAS at all.